If you like your steak somewhere between medium and well done, we may have a stock for you. We've ranked it at 5 out of 10, but on Trackstar, our proprietary sentiment indicator, Financial Pros searched for it more than Darden restaurants and Papa John's. That stock is Texas Roadhouse. Retail investors have been paying attention too. Searches for it spiked in late October following its Q3 earnings and have remained high since. And this got us wondering if there was something more than meets the eye. Texas Roadhouse is a steakhouse chain with nearly 700 locations in 49 states and 10 different countries. In addition, the company owns Bubba's 33, a casual dining bar and restaurant chain. And like many restaurant chains, 2020 was a difficult year for Texas Roadhouse, but the company's net income seems to be back on track. A similar trend is in play with its operating cash flow. It could be in better financial condition, but does still pay an annual dividend to investors. Texas Roadhouse has a notably lower price to cash flow ratio than its peers, and with the exception of Papa John's, it's a similar story for its price to sales ratio and its PE gap ratio. Texas Roadhouse was negatively impacted by commodity inflation and wage and labor inflation, but it did offset some of that with an increase in comparable restaurant sales. It runs an EBIT margin that is mid-range amongst its peers, and it boasts an impressive net income margin of 6.7%. Texas Roadhouse said it won't compromise by offering smaller portions or reducing staff, but instead focusing on service and experience. From 2010 to 2019, its shares appreciated more than 400%, and this year its revenue grew year over year, which beats its rivals with the exception of Dutch Bros. The open question is whether consumers will continue to spend on dining experiences. Most economists predict a recession in 2023, which should negatively impact the shares of Texas Roadhouse. And while we believe it's an excellent company doing all the right things, we'd like to be patient and wait for a better entry. We'd buy shares if they got down to the $80 to $85 range.